Fear that the Biden administration could bring more restrictions to chip exports toward China hit the chip makers hard yesterday. The major US indices fell, while the US dollar dipped below a critical Fibonacci support and, as such, stepped into a medium-term bearish consolidation zone. Now, the European Central Bank will announce its latest monetary policy decision today, while Netflix and TSM will go to the earnings confessional. So we have a lot to cover at today's episode. Welcome. This is Swissquote's Daily Market Talk. While everyone, including myself, is speculating on how the ongoing international trade war and tensions could worsen if Donald Trump returns to the White House in November, well, it was Joe Biden who delivered a blow to the market yesterday as his own administration told allies that it is considering severe restrictions if companies like the Japanese Tokyo Electron or Dutch ASML keep providing China with the tools that they need to access advanced chip technology. And indeed, despite restrictions to exports to China, the surging sales to China accounted for almost half of ASML's revenue in the second quarter of this year. Now, note that ASML is the only producer in the world that makes tools to produce these advanced chips that we are talking about here as such. And well, despite a breathtaking rise that they announced in their orders from around 3.9 billion US dollars to 6.1 billion US dollars yesterday, while ASML shares tanked nearly 13% at yesterday's trading session, pulling the Stoxx 50 index down with it. Tokyo Electron, on the other hand, dived 7% yesterday, another 9% today. Nvidia fell more than 6.5%. Broadcom dropped almost 8% as AMD crashed more than 10%. And even Tesla, well, fell more than 3% at yesterday's trading session, despite Katie Wood's prediction that the robo-taxi platform that Elon Musk is working on could eventually boost the company's stock price by tenfold. Always very humble and always very reasonable, this Katie Wood, isn't she? As such, the S&P 500 fell from a record level at yesterday's trading session as the technology-heavy Nasdaq 100 fell almost 3%, printing its worst trading day since 2022. So let's see if earnings from Netflix and TSM today could put a smile back on investors' face and help TSM, which also lost 8% at yesterday's trading session, recover a part of these losses. But yesterday came as a proof that we do not necessarily need Donald Trump in the White House to fuel the trade tensions with China and wreak havoc across allies. Joe Biden is in fact very, very good at doing that job too. Now, yesterday's big technology sell-off hit sentiment in small caps as well. The Russell 2000 index gave back 1% as the US 2-year yield rebounded slightly yesterday on cautious comments from the Federal Reserve's Christopher Waller, who said that the Federal Reserve is getting closer to cutting its interest rates, but that he needs more evidence that inflation in the US is on a solid path toward the 2% policy target to back a concrete move. So the sell-off in the US dollar index accelerated as the index pulled out a crucial Fibonacci support at yesterday's trading session, which is the major 38.2% retracement on year-to-date rally. The sharp rise that we saw in the Japanese yen amid a suspected FX intervention from authorities, and the rally that we saw in sterling following a stronger than expected British inflation data yesterday, helped fueling the bearish action in the greenback at yesterday's trading session. As such, the US dollar index has now stepped into the medium-term bearish consolidation zone. And obviously, potential for a further weakness in the coming weeks, and the fundamentals including the full conviction that the Federal Reserve will start cutting its interest rates as soon as in the September meeting, will support the negative dollar outlook right now. Now, rapidly coming back to sterling, cable cleared the 130 offers yesterday after a set of stronger than expected CPI figures from the UK hammered the expectation that the Bank of England would cut its interest rates in the August meeting. So yes, the headline CPI is now at 2% level in the UK, which is the BOE's target, but the services inflation remains sticky near the 5.7% level. And given that services make up to around 80% of the British economy, these worries regarding the sticky services inflation are quite well funded. Now, what's encouraging, however, is that the latest rise that we saw in British services inflation was due to a 10% rise in hotel and restaurant prices amid the effects of an almost 10% rise in the minimum wage, but also a Taylor Swift tour. So the Euro 2024, where Brits play the final against Spain, will probably have a temporary boosting effect as well on services inflation and beer prices. But then, if all goes well, we shall start seeing the services inflation in the UK wane and help the Bank of England move toward cutting its interest rate so that everyone in the UK can finally take a breather. But for now, the probability of a rate cut is not on the right direction for the summer. So August probability melted from 50% before yesterday's inflation data to 25% chance of a cut after the data, and it was around 70% last week, remember. So the rapid rise that we see in Bank of England hawks backs the appreciation of the British pound these days, and we could eventually see a further advance in cable's valuation. But given that the Federal Reserve rate cut bets went, well, probably a bit far these days, and that the Bank of England rate cut bets dropped enough, well, the upside potential in cable should be limited. So solid resistance is eyed near the 131.50, 132 area. Across the channel, while the euro-dollar consolidates its gains near the 109.30, 109.40 level this morning. The European Central Bank will meet today to announce that, well, they are probably not changing their interest rates at this month's monetary policy meeting, but any hint that the European Central Bank could cut interest rates in September could slow down the euro appetite today. But still, investors are more convinced today than not that the European Central Bank will announce a second rate cut in the September meeting. Therefore, if today's presser doesn't bring new, unexpected and surprise elements on the table, the euro-dollar's outlook should remain slightly positive faced with the rising Federal Reserve cut expectations. But be careful still here, because the Federal Reserve does may be getting a bit ahead of themselves these days, and the latter could eventually limit the major peers' upside potential against the US dollar near the current and, well, technically important levels. Elsewhere, while US crude rallied at yesterday's trading session on the back of an almost 5 million barrel fall in US oil inventories last week. We were discussing in the comments as well yesterday, so if you missed, you can go and look at them, that Trump's ambitions to boost the US oil production could be a turn-off for oil bulls, but the Trump trade on oil is not that clear, mind you, because yes, Donald Trump wants to pump more oil, but he also wants to scrap the shift toward alternative energy sources and keep demand for fossil fuel intact. Therefore, well, a Trump win this November could even be more positive, in my opinion, for oil than the contrary, given that, well, field production in the US is already at all-time high levels under Biden, so we can't say that Biden is not pumping enough. So with the demand prospects increasing, combined with the reflation positive environment, could reasonably keep oil on a positive track above the $80 per barrel key support level and help the barrel of oil make another attempt on the $85 per barrel level. But note that appetite above this level will likely remain limited, as higher oil prices boost inflation expectations and also boost the Fed hawks, and well, that has a natural cooling effect on bullish bets for oil prices. So that's all for today. I'm İpek Özkardeşkaya and thank you for joining me and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates, and subscribe to our YouTube channel for daily market comments. And also, please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.